Hi, I'm Steven Sun at Homes by Sun with REMAX here to guide you through some critical updates from the 2024 federal budget that could greatly impact your real estate decisions. Whether you're looking to buy or sell this year, understanding these changes is key to maximizing your financial outcomes. The 2024 federal budget introduces major reforms aimed at ensuring that high-income earners contribute their fair share to the tax system. The changes include modifications to the capital tax structure, as well as alternative minimum tax, or AMT, which are particularly relevant to real estate investors and homeowners. Now, historically, capital gains tax has been a tool used to tax the profit from the sale of non-inventory assets. The inclusion rate, that is the portion of your gain that's taxable, has changed, affecting how much tax you pay when selling properties. As of June 25th, 2024, the government will increase the inclusion rate from 50% to 66.67% for capital gains exceeding $250,000 annually. This is a shift to ensure wealthier Canadians pay more in line with their earnings. So let's say you sell an investment property with a capital gain of $500,000. Under the old rules, you'd be taxed on only 50% of $250,000 of that gain. But with the new rules, the taxable gain on the first $250,000 remains at 50%, which is $125,000. But the taxable gain on the additional $250,000 will be at 66.67%, equaling to $166,675. Therefore, the total taxable gain is $291,675. This increase means paying taxes on an additional $41,675, which greatly impact your returns. Now, unfortunately, for corporations and trusts, the impact is even more significant. Starting from June 25th, 2024, the capital gains inclusion rate will change to 2/3 for all gains. This uniform rate applies to all capital gains without the $250,000 threshold that provides some relief for individual taxpayers. This means if a corporation or trust realizes the same capital gain of $500,000, taxable gain at 66.67% inclusion rate will translate to $333,350 taxable income. This change will increase the tax burden on corporate entities and trusts, potentially affecting decisions on asset management and timing of disposition. However, there is also something called the alternative minimum tax, or AMT, that you should be aware of, and it also has an impact on the taxes payable due to capital gain tax changes. The AMT was designed to ensure that everyone pays at least a minimum amount of tax regardless of deductions or credits. The recent budget not only increases the AMT rate from 15% to 20.5%, but also broadens the income considered under this tax, which now includes 100% of your capital gains, up from 80% previously. Now here is how this impacts you. So say you have a high amount of deductions that reduces your regular tax calculation significantly. Under the new AMT rules, your deduction will have less impact and potentially increasing what you owe. For example, regular tax on a $500,000 gain at 33% tax rate might originally show $82,500, but under AMT, the full $500,000 is now taxed at 20.5%, leading to $102,500. That is a potential additional AMT of $20,000 due to fewer allowed deductions. In order to protect lower and middle income individuals from AMT, the AMT exemption amount is raised significantly to start at the fourth income level of the federal tax bracket, $173,205 for 2024, and will be indexed to inflation going forward. The proposed budget is set to be in place by June 25th, 2024. In order to avoid their impacts, you may still have time to take some precautions or consider realizing your gains before that date. Here, I'll give you 3 ways to reduce your exposures under the new capital tax gains changes. Number 1, if your assets are held in a trust, you may be able to defer any substantial capital gains payable to the beneficiary to be claimed as personal capital gains. That would allow them to use the $250,000 low inclusion bracket over a number of years. Now, number 2, consider selling any assets that are in a loss position to offset any realized or potential capital gains. This strategy is known as tax loss harvesting and can help lower the capital gains reported. Number 3 is obviously to sell the asset prior to June 25th, 2024 to reduce your capital gains exposures. It's very important to have a good strategy regarding your financial planning, especially when it comes to managing significant assets like real estate. As your dedicated real estate professional in Toronto, I'm here to help you navigate these complex tax landscapes and optimize your investment strategies. If you have any questions or need personalized advice on your real estate investment in light of these new tax changes, don't hesitate to reach out. Together, we can ensure that your real estate decisions are informed, strategic, and beneficial. Again, I'm Steven Sun at Homes by Sun with RE/MAX. Thank you so much for watching, and I hope to hear from you soon. Take care. Bye for now.